Hi, this is Lisa here again, and welcome back to our accounting basics. Today we'll be discussing about some of the basic accounting concepts. So, what are these accounting concepts? These are basic rules, assumptions, and conditions that defines how accounting operates. These are the generally accepted accounting principles which forms the fundamental basis of the preparation of the financial statements. So the objectives of the accounting concepts are as follows. Its main objective is to achieve consistency in the preparation of the financial statements. It acts as the underlying principles in preparing and maintaining business records. It also helps to achieve a common understanding of the rules to be followed by all business entities and therefore facilitate the comprehensive and comparable financial information. Okay, so the first one is the business entity concept. This concept states that the business is separate and distinct from that of the owners. So your business has its own personality, which is recognized by law. It can so the preparation of the business entity records must only pertains to those transactions that is related to the business. You should not mix your personal income and expenses to your business transactions. Next, we have the going concern. It states that the business is assumed to continue to operate for a longer period of time. So this means that the financial statements are prepared with the assumption that it will continue to operate in the years to come. Next, we have the monetary value concept. This means that the economic activities of the business are recorded in terms of money. So if you can remember in the definition of accounting, the business transactions are recorded in terms of money. So if, for example, one of the uh, economic activity of a business is hiring employees. At the time of hiring, there is no there is no monetary value yet. But once you pay their salaries, there now comes the recording of the business transaction because it has now a monetary value. Next, we have the time period assumption. It assumes that the business operates uh, within its accounting cycle depending on the kind of activity the business is into or industry it is part of. So their accounting cycle or financial year is divided into months or years. The accrual basis of accounting states that income is recorded when earned and expenses are recognized once it is incurred. So, in contrast, we have the cash basis of accounting, which recognizes income once cash is received and recognize expenses once cash is paid. So under the accrual basis of accounting, uh, this is the generally accepted accounting principle uh, because all in in the reporting of the financial transactions, uh, it should be within the period that the income and expenses are earned and incurred respectively. Next, we have the stable monetary unit. It assumes that the monetary unit used by the business is stable and it does not consider external factors such as inflation. We have the matching concept. This means that the business has to record the revenues and the expenses that it pertains for the same period. So, this is in accordance with the accrual basis of accounting. Next, we have the cost concept. It states that any assets acquired by the business are recorded at its acquisition cost or historical cost. Next, we have the realization concept. This means that the business has to record an asset at cost until it is sold or disposed of, in which case it will record the asset at its realizable value. The realizable value is equivalent to its proceeds or the sales price minus all the expenses related to its sale or disposal. Next, we have the dual aspect. It states that every transaction has two aspects, debit and credit. This is the concept behind the double entry bookkeeping system. So every transaction has twofold effect, debit and credit. So for example, if you purchase a land, you will record the land as an asset, and for example, it is paid in cash, you will credit cash on the amount of the land. Next, we have conservatism. It means that the business has to provide for expected losses or expenses, but should not recognize future expected revenues. Next, we have consistency. It states that the business has to follow the accounting policies consistently to achieve comparability of the financial statements at various periods and with the same entities in the industry it operates. And finally, we have materiality. The financial statements must disclose all items which has a significant effect on the business. So, for example, the business is considering to purchase a big machinery or it's going to wind up uh, one of its departments. So this should be disclosed in the financial statements because this has a material effect. This has a significant effect on the business and its financial statements. So that ends our discussion on the basic accounting concepts. See you on our next topic and have a great day, everyone. God bless.